Let's talk about mortgages for older applicants. I'm not talking about lifetime mortgages or equity release. These are traditional residential mortgages that are people a little bit older and are looking to get maybe a higher term, maybe a longer term, how affordability impacts things. What about interest only? What about pension contributions? What about retirement ages? So let's get into it. As more and more people, more and more first-time buyers, next-time buyers become older, we've got a bit of an issue. We've got an issue whereby your traditional mortgage, and obviously property prices getting more expensive, those sort of boundaries that you used to have, you go up, you go to college, you go to university, you come out, you settle down and you get a property. Well, those things are moving and changing. And obviously a lot of people now looking to either downscale some of those older people. Maybe they've had their kids, the kids have grown up, they've gone to university and they don't need that 5-bedroom house anymore. And they want to get a smaller proportion of a property, or they're looking to refinance, to gift. Remember, the biggest source of deposit at the moment are family. So it's friends, it's mother and father for their children. So there are lots of reasons why people now that are older are still looking to get a mortgage. So many years ago, you used to buy a property for £20,000 and then, now it's worth £500,000. And that's all great, but things have changed quite a little bit. And especially what I've realized is with the advent of the interest-only mortgages, that a lot of people that have been stuck maybe got on an interest-only mortgage and never really come off it. So those things are there. So whether you're looking to get a remortgage, to fund deposit, home improvements, moving new houses, helping family members out, or remortgage to invest in new property. So you could be a property developer or want to get into buy to let, and you've got a lot of equity in your property and you're looking to take that money out. So there are lots of reasons why people are taking out mortgages when they're a little bit more older. So I've written an article on this on our Niche Advice website that's a lot more in depth, to be honest with you, and I'll try to cover more of the points, but I'm just going to touch on some of the big points. So the first point is, what's the maximum age lenders will work to? Well, different lenders have got different criteria. I think before I answer that, we've got to look at what the historical sort of things are around retirement. Okay, so the traditional sort of retirement was 65 years. Lenders then said, okay, we'll lend up to 65 years. Okay, so it doesn't matter what the age is of the client, we'll lend up to 65 years. Okay, then, you traditionally could get a 25-year, 30-year mortgage. So then lenders moved it to 67 years. So as a normal rule, a lot of the lenders would let you borrow up to the age of 65. Now, there are rules around this. Some lenders will go the oldest applicant, and the majority of the lenders, the oldest applicant's age. So if it's a husband and wife, they'll work off the oldest applicant's age until they reach the age of 67. Now, in the last few years, that 67 years has actually moved up to 70. So a lot of the lenders will allow you to lend or borrow up to the age of 70 without needing additional documentation to prove affordability during that period. So after that period, I'll give you an example. So a lot of the lenders will go, right, so there are lenders that will say, well, it allow you to borrow up to the age of 80. You go, oh, that's great. But up to the age of 80, from 70 to 80, they want to see pension provisions to be able to suit your affordability. So you need to have enough pension to cover the mortgage, okay, which a lot of people may not have, okay? So don't be fooled by that marketing bit. It's just a bit of marketing. Oh yeah, we'll go up to the age of 80 or 85. The key driving point is what age they will go up to, which the norm in the market is 70. They'll allow you to work. There are some lenders, high street lenders, that will allow you to work until the age of 75, okay? And there is one or two that will allow you to work until the age of 80. Now, plausibility is going to be important on that, right? If you're a bricklayer, the plausibility of working until the age of 75 is going to be very hard to do. However, if you are, a barrister or an administrator or an accountant or something not physical, then if it's administrative, if it's not too physical, then if it's viable, then that's absolutely fine. There are lenders that will do that. So That's where the rules are at the moment. So 70 is the norm, 75, there are a couple of 80. Now, it really helps because if you are in your 50s, okay, and you still need to get affordability, because remember, a lot of the times it really does affect things. If you're taking out a mortgage over 10 years or you're taking out a mortgage over 17 years, there is a big difference in it. And in my article on my website, and I'll put the link in my description, I've actually broken that down. I've broken it down and I've named a couple of lenders. Okay, so go and check that article out. In fact, what I will do is I will run through it now and I'll put the article up. How about that, guys? Let's go and see if I can do that. Yes, so I've given an example here how the term will affect things. So a length of a mortgage term can directly have an effect on your borrowing. Okay, an example is a single lady employed on £50,000 per annum buying a house for 15 with a 15% deposit, no personal debts or no dependents, council tax is around £150, taking a 4.20 5-year fixed rate on a repayment basis. Right, so I did this example day before yesterday, 11th of the 2nd, 2024. Right, so lender number one, Barclays, Halifax and NatWest. Term of 5 years. This is how much you can borrow, 91,626. Term of 10 years, that jumps massively, guys, 148,038. Term of 25 years, 217, and term of 35 years, 230. So that gives you an example. That I'm not saying that's what she can get, but what I'm saying is this is the difference between different terms. Now you got to remember, if you're taking out the mortgage for a longer period, you're paying interest on a longer period, which means it's going to be more expensive for you in the long run. Okay, but this gives you an idea of how the term of a mortgage can have a direct impact on the maximum loan. Right? So as long as you're not pushing it, then you can go for a shorter term. And remember, you've still got flexibilities of overpayments, for example, paying a mortgage down up to 10%. A lot of the banks, some banks will do up to 20% per annum, and you can reduce the term of the mortgage once you've actually got a mortgage throughout the process. So it really does help. And I've talked about the shortening of the length of the mortgage. Now, let's talk about a couple of things which is to do with mortgages. Let's move away from that. Now, something else. So in regards to pensions, right, there are different rules around that. So some lenders will go, if your retirement is within 10 years, we want to see that you're paying into a pension, for example, as part of employment. Now, pretty much everybody is now because you have to almost, but they want to see that. They want to see that actively. Now, some lenders will actually underwrite that. So some lenders will go, okay, well, how much are they paying on a monthly basis to the pension? Others will go, no, as long as they're paying into a pension, we don't care if it's £10 or if it's £1,000. Okay, so that's important. Okay, so those sort of things will have an impact on things. Pension contributions as a whole is a funny one because some lenders see pension contributions as a good thing, which I think is a good thing, that you're saving for the future. Okay, so if you're getting £2,000 a month salary and your pension is £200 a month, they see that as a good thing. They do not take it as a loan commitment or an affordability or reduce your affordability because you're saving £200 towards your pension. Other lenders will say no. Other lenders will say, well, actually, if they're going to get £1,800 a month net pay, that's what we're going to use for the affordability. We will essentially see that £200 as a commitment. Okay, as something that they're not receiving, which I think it's a bit short-sighted because ultimately we want to encourage people to be able to afford that property longer term, maybe have a pension pot if the mortgage is going towards the end of the year. I think it would be an end of the term. So I think that's actually a really good thing that people are saving on a pension. And often people in the NHS, nurses, doctors, teachers, civil servants, they get penalised by some lenders. Not all. I mean, majority of the lenders, they will ignore pension contributions, but there are some lenders there that will take that into account as a commitment, especially when you're dealing with the specialist lenders arm. You know, people that have had, maybe they're self-employed or maybe they've got credit issues or the self-employment is recent or something specialist in the need. Those lenders tend to be, although they're very good on flexibility around adverse credit or credit profile and things like that, they're not that great, some of them, on affordability. And that's when things come up. So anyway, So how are people getting around this? Okay, so how are my clients dealing with things, right? There are a couple of things you can do, right? One, we've got lenders that will allow you to work onto the age of 80. That's really good. So that's one thing. Oh, one more thing, guys. Around interest only, I get this quite a lot. People often come back and say, right, I want a 20-year mortgage. They're in there, I don't know, 55, 57 years old. I want a 20-year mortgage and I want it to be interest only. And I want the sale, the repayment strategy to be sale of property. A lot of the lenders will not allow you, I would say a lot of the mainstream lenders will not allow you to take out an interest-only mortgage beyond the age of 70. So that's one. There are additional criteria that I've been putting over the last few years around interest-only. One of them is generally they're targeting high net worth individuals, which means you've got to have an earning of, I don't know, 75k, 100k. So that's one barrier. The next barrier is a lot of the mainstream lenders have got minimum equity in the property. So they would say you must have £250,000 equity in the property. You must have £300,000 equity in the property. Others will go, we will not allow you to go beyond 50% loan to value or 60% loan to value. So there are lots of rules when you're trying to combine this stuff. And I don't personally think it's a great idea to go for an interest only mortgage and go near your retirement or beyond the normal retirement age. So I actually agree with the lenders. I don't think that's a great idea. I think you're just, we're still dealing with the problems of the last 20 years, people being on interest only mortgages, and all of a sudden, yes, they were on 1% rate and now they're coming on to 10% rates, potentially some of them, because the lenders are not offering them new products because they're too old. Okay, and they've got to stay on the lender's standard variable rate. So I think that's a sensible option, but that's to touch on the interest only element of things. So when it comes to, let's talk about how we're helping people. So as I mentioned, lending age of 80, 75 is quite common. Running affordability, I've just shown you, and working at different lenders have got different sweet spots when it comes to the maximum term. We've got lenders that will work off, I'll give you an example. The most common one that I'm doing at the moment, mother and father own a property. They can't remortgage it because they're too old and they're not working. The son is working, he's young enough, so we can do a joint mortgage with the three of them, working off the son's age and income. As long as that fits, we'll ignore the other two's income and age, which is really good, which means they can essentially get a 35-year mortgage if they wanted to. So there's a lot of that going on, okay, in regards to the age, okay. There are some lenders that have got, they will say, okay, although our retirement age is 70 or we go up to 80, however, if one of them is not contributing towards affordability, then we'll work off the youngest person's age, okay. So husband and wife, the wife is the earner, the husband is older. Well, they'll go, actually, we can see the wife is the earner and we can see she's the younger, so we will discount the husband's age, so we can work off the youngest. So again, that's a beauty. You have got, those type of facility, those sort of things are available, okay? And understanding their job profile, that's going to be so important. Remember, we talked about the bricklayer and we talked about the accountant, for example. So there are flexibilities in that, and understanding around what they want in regards to pension contributions, no pension contributions, and how that's going to work, and what is the overall strategy, what's the exit strategy, what are you trying to do? Is this a short-term fixed? You want to get a 2-year fix because of what are you capital raising for, how are you going to get the money back? Remember, there are also, it all sounds great saying, oh yeah, you can just put your son on there and the son can get the mortgage. But what happens if the son wants to go and buy a property himself? What are you going to do in 3 years' time when the son goes, do you know what, I want my own flat, I've had enough of you guys? And hopefully that's not going to be the case. But you've got to think, okay, how am I going to get out of that? Okay, so very easy for a mortgage guy to sit in front of you and sell you this dream. Say, oh yeah, no, that's possible. You want the money? Here's your money. But the downturn is that there are issues, and this is one of the biggest things that I get with family mortgages. Okay, a lot of people are helping each other out right now, buying together, pooling in their wealth, pooling in their thing. But what happens if you want to unravel that, dismantle that? So careful consideration needs to be given, but certainly we're doing a lot more around this. Just to touch on the buy-to-let element of this is very important as well. When it comes to buy-to-let, things are a lot more easier. Okay, so there are many lenders that don't have age limits. There are lenders that will go up to the age of 85, 90. So age is not so much of an issue. I get so many people phoning me up and going, yeah, but I've got a buy-to-let mortgage. I've been on there for 20 years. My mortgage is running out. What am I going to do? Don't worry about that. There are plenty of lenders now that would go well beyond the retirement age. Remember, you're a landlord. You're running your own business. That business is not manual labor. So there is a lot more flexibility around that as long as you've got the key people, even people that are directors of limited companies. They're older, as long as you've got a path for somebody else, maybe your son's coming onto the company, so forth. So, there is a lot more flexibility, and there are a lot of lenders. Literally, they don't have minimum incomes, minimum ages, and minimum incomes, for example. So it's a lot more cleaner and is a lot more simpler when you're dealing with investment properties rather than residential properties. Obviously, residential properties fall under the FCA, the Financial Conduct Authority's guidelines. Anyway, let me know what you guys think. Let me know if there's anything else that you want me to talk about, and I'll catch you on the next one. The content of this video does not constitute giving advice. It's purely for information purposes. All cases should be discussed with a professional mortgage broker. As a mortgage is secured against your home or property, it could be repossessed if you do not keep up mortgage payments. Niche advice is authorized and regulated by the Financial Conduct Authority.